block sales and that. Okay, so when and this mostly has to do with, well, mutual funds for one. Does everybody know what a mutual fund is? Yes, no? You don't have to. All right, well, a mutual fund is a group of stocks. So you have, and there are people that manage mutual funds. So instead of just buying Apple as an individual stock and Microsoft as an individual stock and Tesla as an individual stock and, you know, individual technology companies, you decide that you want to hedge your risk, because it could be that Tesla is going to go down and Apple is going to go up. And you want to make sure that you kind of even out your risk. Well, mutual funds combine stocks from different companies. So they have like a whole grouping of stocks. So you have mutual funds that are, you may have mutual funds that focus on technology companies, mutual funds that focus on pharmaceutical companies, mutual funds that focus on food companies, restaurant companies. Oh, you open that for him. Locked himself out. So you can have these mutual funds that focus on specific industries, or you can have mutual funds that are more broadly based. They try to match like the S&P 500 or the Dow Jones or you know, any of those greater markets. So it's a grouping of stocks. Well, the mutual funds themselves have a value. When you purchase shares in a mutual fund, you're purchasing shares in a whole bunch of companies. And then that mutual fund itself, its shares, mutual fund shares, have a particular value. Well, what's happening in mutual funds is all the time the mutual fund manager is buying and selling stocks. They're going throughout the year, they're buying, you know, buying some Apple, selling some Apple, buying some Tesla, selling some Tesla, yada, yada, yada. Well, they are incurring all of these gains and losses when they're doing that, right? Because anytime we sell something, we're going to have a gain or a loss. So what happens is at the end of the year, they will tally up all of those. Hopefully it's been a net gain. The gains are then spread out amongst all of the mutual share owners. Okay, so if you own 100 shares in a mutual fund that has 100,000 shares, you own 1% of that mutual fund. If they incur $100,000 of capital gains that year, your share is going to be what did I say? 1%? 1% of $100,000. So $100. That's going to be your share of the capital gains. You have to pay tax on that. That's a capital gain distribution. So I had mentioned on the Schedule D, if it's showing here, yes. No. That's a 4797. You guys are going to have nightmares about that form. Right here, capital gain distributions. They are reported on the 1099. The shareholder, the mutual fund shareholder, doesn't have to calculate what that is. It's reported to them. It's all going to be taxed at a long-term tax rate. They just combine it all. They don't divide it up between short-term and long-term. Okay? But it gets reported, and then it goes on line 13 here, and it gets combined with other short-term and long-term losses and gains and losses on the Schedule D. So that's what a mutual fund capital gain distribution is. Block stock. So when you buy stocks, you don't just buy one group of, you don't just buy one stock and then sell that one stock and then you buy another stock, and like one at a time. What oftentimes happens is you buy different groups of stocks. So let's just say that we bought some Apple. January 1st, 2015, we bought 100 shares, and it was trading at the time at $100 a share. So, what is that, $10,000? This is our basis. And then we bought on January 1st, 2019, another 100 shares, and it was trading at $80 a share. So, $8,000 basis. And then we bought 2022, bought another 100 shares, and it was $120 a share. So our basis here was $12,000. And then we sold, so these are all bought, sold 150 shares on 12/22. We sold 150 shares. Which 150 shares did we sell? We have some choices. Now, here's the thing. If we sold it, let's say that we sold, so 150 sold, and we sold it at $150 a share. So we got a gain, right? What is that, 15, what did I say, 22.50? Sorry, 22,500. This is our proceeds. Now, if we sold these 100 shares, is that short term or long term? January 1st, 2022, December 12th, 2022. This is short term, right? Our tax rate on that is going to be higher than if we sold this 100 shares, right? This is a long term. We can choose which ones. We can specifically identify which shares we sold in order to take the greatest advantage. We can also use a system called first in, first out. You guys are familiar with that from inventory, right? So whatever we bought first, so these 100 shares we sold, and then 50 of these shares we sold, okay? Or we can take an average of all of them. Obviously, the most beneficial here would be probably to sell, well, if we could sell, no, not all of those. See, this is a higher basis, so it could be, we'd want to calculate, right? Is that, even though it's a short-term gain, it might be a smaller gain, and you know, it might end up being a better deal for us to do it that way. But if we took or like I said, we could take an average of all three bases. So these are block sales, or block purchases and block sales of stock. So there are some nuances to that, and like I said, we've got some choices as to how we want to, so first in, first out, specific identification, or average basis. You could figure out how average basis works. Weighted average of all of those. What else do I want to say? I thought there was one other thing I wanted to talk about. I guess not.